Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. You know, investing is never a game of perfect. I think that's a given. We all know that, and we all realize that. Mistakes are going to be made. And there are some mistakes that are simply unavoidable, and there's really not much you can do about them. But there are some mistakes that are also very avoidable if you just have a presence of mind and the right tools to help you avoid making those mistakes. Now, I'm going to be illustrating one of the major, most easily avoidable mistakes there are, which is paying too much for even a great company, or what I like to call overvaluation. Overvaluation is easy to identify and recognize if you're a subscriber to the FastGraphs Fundamentals Analyzer software tool. I think that's very important. So, we're going to go through about 10 or 11 names here of companies many of you will recognize that were really overvalued, and they've now become reasonably valued, but yet nothing has really fundamentally changed with their business. So let's go ahead and get into the video. Now, as usual, I'm going to do these in alphabetical order, and this first one is Ball Corporation, which a company makes metal and glass containers. And it's an old line company. It's been around a long time. It has very consistent growth most of the time. And you can see how the stock price tracked earnings. The earnings line on this is 15. So in other words, anywhere you touch this orange line, it would represent a PE of 15. So obviously, when the stock is below that orange line, it's trading at a lower PE. Like here in October 24th of 08, it was only trading at 8 times earnings. During this time, it was trading at much higher PEs. And that's one reason why the normal or average market PE has been 18 on this stock, rather than the 15, which would be the earnings justified valuation based on 11% growth rate. Now, a couple of things I want to say before I go any further with this. When you're investing, you get your return from capital appreciation, and that's the price going from point A to point B. But as you can see, the price is going to be directly related to the earnings growth. In this case, we're using adjusted operating earnings. So growth is going to be one component of the return. The other is dividend, and FastGraphs portrays those by the light green shaded area and the white line. The area below the white line is this light green shaded area you see on top of the graph. Now, one thing about the dividend, it's very consistent. But anyway, you get growth. In this case, we got 10.93%. We've got a PE, current blended PE of 15.46, which is just, indistinguishably above the orange line. If we go back to the first point here, December 31st, 2002, the PE was 15. So I want to make a point. I want you to understand this. The company started out in value and is now approximately in value or just a little higher. So the 10.93% growth is what this company is going to generate, plus it's going to get dividend income, and there'll be no PE expansion. So let's go in to the performance report, and let's view that. If you put $10,000 on January 3rd, 2003, and held it to yesterday's close, which is depicted on this graph, your growth was 9.72%. Plus dividend income, it turned 10,000 into 68,000, much better than the market, by the way, which, by the way, is still overvalued, and companies still outperformed the market. You got about $9,000 in dividends for a total of $77,968, or a 10.38%. But I want you to focus on the 9.72% number, because that number is what correlated pretty closely with this 10.9% growth. Now, there were some, weaker moments of growth in here, and we're coming off of a high growth area here. But the point I'm getting at is the growth of the business generated the growth component, and then the growth of the dividend gave you the extra income, and there really was not much in the way of PE expansion. So this company generated, a 10% plus rate of return based on the fact that the business generated that for the shareholders. Now, here's the point of this video, and I'm going to be, reiterating this, but I'm going to do it, with less detail going forward. This is a high-level video. I'm not going to get into a lot of research on any of the companies I cover here. I'm just going to give you a focus on valuation. The company went through a few years of underperformance where they had negative growth, zero growth, real strong negative growth. And the stock marked time. It was interesting here in this particular case. It didn't really kill the price of the stock, even though the fundamentals fell during that period of time. But once the fundamentals accelerated, here we see the 67% increase. The stock got ahead of itself, and all of a sudden, we're looking at PE ratios in the 30s. Then, of course, this gray shaded area represents COVID, the COVID pandemic. And, the stock, had a massive reaction to that initially, but then it got overvalued again, and it stayed up there. And then we hit a down year in earnings. And when a stock is overvalued like this, I call this dangerously overvalued. You could pick almost any point here. I've actually hit the top there. And you can see that the downward spiral here was 50%. In other words, you'd have lost 50% of your money from September 3rd, 2021 to October 17th, 2023. That's just about a 2-year time frame. And your money got wiped out. The company did have a drop in earnings, but the stock price was vulnerable. And I think that's the key point. So I'm going to go through this. The easy mistake to avoid was buying the stock when it was overvalued like this. That's very visual when you're looking at fast graphs. You can look at the great Blackrock, one of the top, asset management and custody firms in the world, the trillions of dollars under management. And the market does like to put a high valuation on this stock. Now, it is AA rated, and, that could be part of this is a premium valuation. But I want you to note once again that when the valuations were high, you really lost the ability to make a great deal of money on this stock. Now, if you'd have bought it back here when it was trading at a PE of 20, the PE is now 17.42, and the stock company grew at 14%. If I go back to performance, I'm going to do it again, and I put the same $10,000 in from January 3rd to October. My capital appreciation was 14%. Plus, I got some dividend income, so I ended up making 15.36%. And once again, outperformed the market, even though the price of the stock has been falling into fair value. Buying it when it was overvalued at any of these time frames would have given you, less than optimum performance. Here you only have 1% performance. Even though long run it's outperformed the market, it's because valuations were so high. Even if I went back here and bought it when the valuation was trading at a 26 multiple, 25.86, and held it till today at a 17 multiple, you made 3.69%. But again, growth is what's important. If you look at the growth rates here, and you go down to the bottom of the graph, the company grew in 2017 by 17%, followed by 19, followed by 6, followed by 19, followed by 16. And then we had a negative 10% year in 2022, and that's when the stock price collapsed. But the overvaluation was obvious if you were paying attention. The next stock we're going to look at is Dover, another really high-quality company in industrial machinery and supplies. You can see the stock price kind of tracked earnings, actually did it at a lower PE ratio than the theoretical 15, which is the orange line. The blue line in this case is a PE of 14.3. But once this stock got overvalued, now it had a really good year in earnings, and that got people hyped up. But then earnings kind of slowed down to 11 and then down to 5. And then the stock, fell from its lofty 22 multiples down to the 16 multiple it currently trades at. I still think this stock is a little expensive, but it's not bad now. You could probably buy this stock now and make money. And then once again, looking at valuation from the beginning here, going to the end, if we run a real quick performance check, we see that the stock, averaged 9.79% growth. With dividend, it did 10.6% rate of return. And, that's consistent with the 10% growth plus dividends. And again, the stock is, a high-quality stock with only 36% debt. So that's Dover. You would not have wanted to buy Dover when it was overpriced like this or any of these times, because even if you buy it here, even though you still made money because the stock grew at a very high rate here, and you still made 11%, I want you to note that if you'd have just waited a few months and bought it here, instead of making 11%, you'd have made 15%. Valuation matters, and it matters a lot. Now, obviously, that's easy to do in hindsight, but my point is, if you're patient and wait for valuation to come to you and only invest when valuation is present, you can do better as a long-term investor. Here's Fiserv, a transaction and payment processor, and once again, we see a long extended period here of high valuation. And even if I go back, here somewhere and pay 25 times earnings, now it's trading at 15 times earnings. The growth rates here have been very strong, 15, 14, 16, 21, 11, etc. But I only made 11%. All right, in other words, the point is I made significantly less than what the company produced as a growth stock. If I'd have really been foolish enough to buy it here when it was at its hottest and then held it to yesterday's close, I would have actually made a negative 0.31% per year. And yet the company continued to grow and do well. It was obvious that it was overvalued during this period of time, and it should have been avoided. The next stock we're going to look at here on the list is Global Payments, another transaction payment processor. Once again, we see this period of very high valuation. Now, if I shorten this time frame, I'm going to shorten it to 12 years. Okay, and look at the growth rate here. It's growing at 17%. So this orange line is now a PE of 17. The blue line is a PE of 21, which simply is a trimmed average of what the market. So there are times when it traded at PEs much higher than 21, and there are also times when it traded at PEs lower than 21. The current blended PE is 11, half, roughly of the normal PE on the stock, and it's very inexpensive right now based on that. But the point is, during any of these overvaluations, the risk you're taking is you could have owned this company from February 2018 to October 2023, okay, 5 years or longer, and because you overpaid for it, you ended up not making hardly any money at all. Only dividends gave you a positive rate of return over your original 10,000. Your capital actually shrunk to 9,800. But here's the point I want to make. If I go down here and look, the company grew by 26%, 29, 23, 28, 14, 12. In other words, the growth rate during this period of time was exceptional. And, you're looking at, again, over 17% growth during a period of time where, let me correct that, over 20% growth during a period of time when the stock really didn't do much in terms of the price, okay? So, valuation matters, and it matters a lot. Here you have real high valuation, a stock that lost 3.35% from April 2019 to 2023, and yet the earnings grew by, almost 15% a year during that time, which is, by the way, very, very fast growth. The point is, the company did great. The shareholders did poorly because they overpaid for a great company at this point. Now, moving on from Global Payments, we went to Johnson Controls. Once again, we see a stock that, is somewhat cyclical, where the market tracks it around a 15 or 16 PE ratio most of the time. And then we had these very high PEs, and it kept bouncing up there, but inevitably it comes back down to fair value. Valuation matters, and it matters a lot. These are just stocks that I'm showing you that have corrected. Monster Beverage, if we look at the long-term performance of this company, it's been exceptional. A $10,000 investment on January 3rd, 2023 would have grown to a staggering 11-fold, $1.1 million against a market that only grew to, 47,000. So what you're looking at here is a 40% annualized rate of return versus 7% in the stock market. Now, if I, measure that like this, from this point here, you just simply see that the 30+% growth is what generated almost a 40% rate of return. And notice there was no dividend. This is a pure example of how the growth of the business generated the rates of return, and how when growth faltered a little bit, we did see valuation come into alignment. Then we had growth explode again, and the stock price got excited. Then it slowed down again, and now the stock has moved back into, approaching fair value at a 31 PE, by the way. Looking at it going forward, though, analysts are not expecting it to grow anywhere near as fast. So I want to make a point that the historical graph shows the evidence that the earnings growth achieved is what generates the rate of return. Therefore, it only logically follows that the earnings growth going forward will be the primary determinant of rate of return. But if the growth slows down to 17%, in other words, that's roughly, not quite, but almost half of what the historical growth would have been, I think you would be rational in expecting the stock to not generate the rate of return that it did in the future, even if it, traded at these 25 multiples. If you look historically, the stock is traded at a 31 multiple historically. So if I go back to forecasting, and look at a 34 multiple here, I would make 17%. That would be in line with the growth. If I made, 25 multiple or 26 multiple, it would only be 3%, rate of return to that point. So somewhere in between there would be, the right number. And the point I'm making is buying this company now, you're buying it on its reputation, not necessarily its future expectations. So if I'm looking at, a 31 typical multiple, I could still make 14 or 15%, but I'm not going to make the 20% that the company is expected to deliver long term. All right, moving on, PayPal. I did a video on it. You can see how the market priced it at very high valuations, and then ultimately the rubber met the road, and now you can buy it at a slight discount to its earnings growth rate. But this was an obvious mistake. No one in their right mind should have been buying this stock, especially at these valuations where you had 50 and 60 PEs, with earnings growth only averaging, 20, 25% per year. Didn't make any sense. Now at a 12 PE, nobody wants to buy the stock, and the company is expected to continue growing at around 14% a year over the next couple of years, and long term at almost 15%. And now nobody wants to own the stock, mainly because we saw the price fall so precipitously here. I'm just picking a random spot. That's a 78% drop from, May 28th, 2021 to October 17th of this year, or yesterday's close. All right, so the bottom line is, when you see high valuations, you should be, alerted and conservative in your views that this is not a great time to be investing in the stock, because, you can buy them up here at these high valuations. Now, Sysco actually had an issue, of course, considering that it's a food distributor, primarily a lot to restaurants, and the restaurants all had to close during COVID. So that's why the earnings collapsed. But notice they've recovered back to what would, be a trend line earnings growth rate. They're back in line with their normal earnings power of, $3 or $4 a share. And so now the company has, historically come back into fair value, and looking at forecasting, expected to grow at 9% a year. So you could buy this stock long term, expected to grow at 14.4% a year. So you could buy this stock today, and if you held it for the long run, probably do very, very well. Now, it might get cheaper. If we look at today's price, which was a pretty rough day in the stock market for a lot of stocks, this one was actually up a little bit. But the point I'm getting at is that you're now buying it at a reasonable valuation. It may not be the perfect bottom, but it's a reasonable valuation at this point. All right, there you have it. This was a portfolio review of, stocks that, of actually 9 companies that have all gone through major corrections. And you could see that the obvious time to not invest in them was when the valuation was above the orange line. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I hope you all enjoyed this video. If you did, subscribe to the channel. Give me a like, and take a look at FastGraphs. You can see how FastGraphs can really help you make better and long-term investment decisions. It's not a short-term trading vehicle. It's designed to illustrate the fundamental value of a business and whether you're able to purchase that business within reason of its fundamental or intrinsic value or not. And of course, you can get it low, like a Global Payments, where it's significantly below that. That's when you have a margin of safety and an opportunity to make some real good money. Anyway, I want to thank you all for watching. This was just a high-level look at these companies, determining whether or not they were coming into value from being overvalued, and trying to illustrate how you could avoid that mistake of overpaying for even the best of companies. Thanks for watching.